Hi and welcome to our Market Insights for July 2017. I'm Aaron Upcroft and I'm here with Rob Gilmour.
Happy new financial year, Aaron.
Thanks, Rob. Before we get into the thick of it for this month, just maybe it's a time to take a look back at the last financial year. Are there any performance indicators of note last financial year?
Well, people are generally interested in what superannuation funds have done over the year, and it was a good year for funds in Australia. A median return was 10.7%.
Right, that's pretty good.
No, it is a very good performance, and not surprisingly, out of that, industry funds did outperform the retail funds again, which is about a 15-year trend, and that's obviously where we prefer our client money to be in if they don't have a self-managed option.
Sure.
But looking more bigger picture, that's the 8th year of growth that we've seen in superannuation in Australia.
That's quite a bullish market. I mean, how long do those cycles normally go for?
Oh, look, there's no defined period in terms of how a cycle would go for. A bull market, typically they don't die of old age, they get killed somehow.
Right.
And when you start to see changes in interest rates, then that's a pretty good flag that you need to be cautious of what's around the corner.
Yeah, sure. Well, the RBA left its rates on hold, but really, despite the cycle that we're in, Rob, I mean, our clients still need to make those big financial decisions, and
Yes.
we're seeing it quite a lot right now, where clients have decisions to make. So maybe we can discuss some of those this month. Like, for instance, would you buy an investment property right now?
Look, in Sydney, no, I wouldn't. I think there's a lot going against investors in the property space right now. I mean, interest rates, case in point, they're being treated differently.
Absolutely. I mean, rates are getting jacked up for interest only, for investors in general. So rates are really high. So returns presumably aren't meeting the market either.
Well, look, you've seen years of price growth, so the prices of property has gone through the roof, yet the rents have stayed the same. So the yields on rental properties are really low, and you'd be lucky to clear 2.5% net in terms of a yield from an investment property right now. And there's no growth. There's no growth because landlords...
We're at the top of the cycle.
We're at the top of the cycle, but landlords can't afford to put the rent up. Tenants are facing rising costs like electricity, so it doesn't look so good in terms of the rental return. And coupled with that, there have been changes to the tax laws, which are restricting some of the deductions around investment properties as well. So I think for now, it's a case of step back, watch this space, rather than jumping into that market.
Yeah, that makes a lot of sense. What about buying a home?
That's a different consideration, because a home, it is a bit more of a lifestyle choice, and it does typically take longer to find the right home for your needs. And this actually might be a really good time for people that have been waiting to buy the home and looking for that home, and it's been just out of reach. There might be a good opportunity around the corner to buy a home, and it's one of those long-term assets that you're going to hold for a very long time. And really, it's not so much driven by the investment numbers. It's a little bit more personal.
That's right.
What's your take on that?
Well, yeah. I mean, they're normally, if it's a 10-year plus kind of investment, investment into your home. Obviously, where you buy in the cycle doesn't make too much of a difference, but rates are low. So owner-occupier rates are really low still. So I expect there's a lot of good bargains out there, or there will be soon to come. So interesting, but I think that's definitely one that could be on the cards for a lot of people.
Look, I think generally speaking, I'm not predicting that there'll be a crash in Sydney property and property generally. I mean, if you're going into it with a long-term view, you're always going to come out trumps. But obviously, right now, it's time to think about that decision a bit more carefully.
Of course. Shares, would you buy?
Look, shares, different consideration, because shares you can actually average into over a period of time. You don't need to put $500,000 or $1 million into shares straight away. It's something you can do over a period of time. So it's a very different type of commitment in terms of an investment.
Yeah.
Also with shares, you will be able to get better income from shares. So you could probably structure a portfolio that could at least cover the interest costs, for example.
Would you borrow? I mean, would you borrow to buy shares at the moment?
I think that's a very important consideration. You've got to always look in terms of personal circumstances, but I think it is acceptable to borrow shares just because of those two reasons. You don't need to go too hard into the market, and if you buy quality, you can buy income, and you can buy quality that actually sees those cash flows grow over a period of time. Same with property. If you've got that long-term view, buying into shares and doing it over the years is a great strategy.
Yeah, sure. And so, look, really, next steps for our clients, I think. Look, debt's obviously one. There's a lot changing in the cycles. Clients really need to review their portfolios, whether it's an owner-occupied loan or an investment loan. Lots to do there. What about on your side?
Look, definitely. I mean, to get some advice, look at how your debt's structured. Make sure it's structured efficiently.
Of course.
And if you are talking about borrowing to invest, then it is important to have a plan and make sure you know what you're doing and do that over a period of time.
Absolutely. Well, that's our market insight for July 2017. We'll see you again next month.